You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program where we break down the sometimes scary, sometimes just head-scratching, sometimes quite fun world of options for you, the busy financial advisor and asset manager, or maybe you're out there looking for the aforementioned services and you want to know maybe what skills they should bring to the table. Either way, we got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which you're listening to this fine program. Right now, if you like what you hear, make sure you head out there to the platform of choice where you find this program. Leave that review so others can continue to discover the program. We have, of course, seen a lot of folks flocking to the network over the past few months. Understandably, a lot of folks have a lot of questions about what's going on out there. They also have a lot of time on their hands to analyze the market, so we're happy to be able to keep you informed, keep you educated, and hopefully a little bit entertained and enlightened as well. And keep those questions coming. At the end of the day, we do love to hear from you guys. And joining me on the old program today, first off, going on all the way out, dialing that dial all the way out to the scenic and sunny lands, really, of Puerto Rico. We are joined once again by the Director of Risk and the Portfolio Manager over there at SWAN Global Investments, a.k.a. Mr. Chris Hausman. Mr. Director of Risk, welcome back to the program, sir.
Gentlemen, good to be back. I'm finally back in the office, so my work from home days are now officially over.
Of course, isn't your office like 5 feet from your house?
A little bit more than 5 feet, but yeah, but that'll be our secret.
Like 12 feet. 12 feet from that. So your commute. The commute is back on. You gotta get the coffee, you gotta get the listening device, to all the good stuff going for the lengthy commute that the Director of Risk has. And we head on out there to another guy who's got a lengthy commute. We're gonna dial that clock handle back up the Atlantic, all the way to the coast and in a little bit, where we get to the scenic options mecca known as New Hampshire, where we are joined once again 2 days in a row, it must be a record here, by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the program, to you as well.
Good to be back, Mark. It's been a long time, 24 hours. I don't know what I was doing, but great to be back here.
We're going to work you this week, sir, so hopefully your voice can hold up. And last but not least, if there's a silver lining to all that has unfolded over the past few months, one of them is that it has curtailed the travel schedule of one Mr. Eric Cott, the Director of Education and Business Development over there at the Options Industry Council, which means he's free to join us yet again for a record third time in a row here on the Advisor's Option. Mr. Cott, welcome back to the Advisor's Option show, sir. It has been too long.
Well, thank you, gentlemen, for having me back. I go back a few months ago to the infamous Fat Tuesday in February and joining you guys around that time. And here we are, virtually 90 days ahead of time. And as you said, Mark, education, keeping people informed and enlightened is surely the mantra of the Advisor's Option show.
And it's also our mantra to break down some of what's going on out there in this space. And you probably need it these days more than ever. So without further ado, let's get the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. This is indeed the portion of the program where we break down what the heck is going on out there in the world of options and derivatives and all sorts of related topics like volatility and alts funds and things like that. So you, the busy financial advisor and asset manager, so you don't have to. We'll kind of curate it all for you out there. And we have to start as we have for the last few shows now because we are in these unprecedented times. Matt, I do believe yesterday you said on our network that these are pretty much the strangest markets you've ever encountered in your history as a professional in the markets dating back to the early 80s. And I have to say, I do somewhat concur with that sentiment because we are in this absolutely unprecedented time for a number of reasons. You know, we've been saying on the show of late, of course, we saw the massive sell-off heading into late February and into the middle of the maelstrom there in March. We saw things like the VIX spiking over 80 and then coming back off. And we all talked on the show, you know, would there be a V-shaped recovery? What would that look like if indeed it did come to pass? If it came to pass, it'd be like the mother of all V-shaped recoveries. All of us on the show never really thought that was really in the cards. And we had, you know, talked to a lot of our audience and asked you guys as well. And it seemed like all of you were really aggressively fading a lot of that recent rally. And yet, lo and behold, here we find ourselves recording this at the end of May here. And most of the major indices are now within spitting distance of the levels that they were pre-pandemic. And so effectively, we have had, at least for the time being, a V-shaped recovery come into showtime. We're seeing VIX well shy yet again of that 30 handle, down to about a 28 handle or so. So well off the highs of 80, but also well below the levels we saw in the mid-50s, and so not too long ago there. So obviously a VIX around 30, still extremely elevated, so don't take that to mean there is no volatility out there. But still a very different volatility regime than we were in even a month or two ago out there. And all this is kind of coming on the heels of still a lot of quizzical sentiment, shall we say, out there on the street. Rick, we were joking on our options bootcamp program yesterday. We haven't encountered anyone yet who's bullish, and yet the market continues to rally. Looking at some data coming out of the Journal, crunching the numbers here on Michigan's consumer sentiment, they said the divergence between consumer sentiment for the economy and monthly percentage change of the S&P is the largest it's ever been. It's 32 percentage points right now, which means the consumer outlook for the economy is miserable, and yet the S&P continues to rally. So we are in rarefied, certainly unprecedented territory. The markets are rallying almost, it seems like, in spite of everything that's going on, perhaps not because of it. And so we're in very, very interesting time. What's the old Chinese proverb / curse? May you live in interesting times. We are all certainly doing that. Let's start out there in the hinterlands of Puerto Rico, actually, where he's tired from his lengthy commute, but hopefully he can last the entirety of the show. Mr. Director of Risk, once again, we find ourselves in this weird environment now. Markets have effectively almost recovered from this and are pricing in going forward like the worst is behind us. What are your thoughts on what we're seeing out there, maybe in terms of overall valuation, in terms of volatility, in terms of anything else that is catching your eye in this rarefied era right now, sir?
Well, it's definitely a liquidity-driven market. Unfortunately, if you look at a lot of charts, or fortunately now, one of the charts that you have to look at all the time is called the FAR-BAST index. It's the U.S. condition of all Federal Reserve banks, and basically, what's going on with central banks and liquidity expansion. And really, it's become, if that chart is expanding, you're essentially in buy the dip mode. If it's contracting, then sell-offs will have a little bit more power, et cetera. I mean, that's kind of unfortunately what it's coming down to. It has to be one of the charts that you look at in conjunction with all the other things when you're trying to assess, where the market's going to go or not going to go. As far as volatility is concerned, it has calmed down. What I've noticed is, we're definitely in a higher low, higher high environment right now over the last month or so. Every dip in the SPX is no more than, call it 150 to 200 handles. And magically there seems to be buyers every time showing up. But what you do notice is that the VIX index anyways does pick up a little bit of steam when we have these sell-offs. But again, none of these sell-offs are more than 3 days old, and they seem to stop right at about 100, and we'll call it 175 handles before buyers start coming in. So the big battle right now that we're having over the last couple of days is right at the 200-day moving average. So should we be this high? I don't know. There's so much liquidity being pumped into the system. In addition to the stock market is now, it's always been forward looking. Economies are opening up. People are now stepping outside and going to begin shopping, hopefully, once again. But there's still some unknowns. I think that, for the next month, until we get data for Q2, then we'll start seeing how the market interprets that. But right now, there's still some unknowns. But I think we're in this calm period. We're in the calm after the storm. And so the market's just going to slop around and let the Fed do what it wants to do and buy every single dip right now until we get some data that's going to turn this thing the other way.
Yeah, we are in that weird period. Speaking of data, we'll get to Matt and his earnings analysis a little bit later. Matt, before we get to all that fun stuff, and just a little bit of a prelude to that, we're not even getting really the good data on the earnings front because everyone's saying we have no guidance. We can't possibly give guidance. So everyone's just kind of spitting into the wind, and yet we're rallying. But I digress, sir. I know it's been a full 24 hours, giving you a little time to ponder all that's going on out there. What are your thoughts on what we're seeing out there, the current valuation levels, the current volatility levels, and what we've seen pretty much play out in the marketplace over the past month since our last show, sir?
Well, one of the things about having all this data is I could look at what the option market says, and it's helped me. I was at a show in Dallas, OIC show, and back in September, and mentioned, it looks like a tailwind for the market, looks good for the market, and then it looked good all the way until January, when we saw a spike. That could have been some insider trading from some of the senators selling out. It coincides with that we saw a little dip in the market.
I refuse to believe such things. What are you implying? How could that possibly come to pass?
No, that's in the news. That's not conspiracy theory, Mark. That's in the news. And then and on the show, I said, it looks like something's happening, and then it did, just a little bit early. And then we saw at the very bottom, maybe 2 days early, capitulation when the market makers really widened out the markets and the volatility spiked. And so that did look like a capitulation bottom. But then I've been calling for, kind of the other shoe to drop, and just looking at history and all that, and that's failed miserably since this bull run. But I'm seeing some signs, chinks in the bullish move, Mark. So we're getting down towards this level in VIX that, if it goes down much lower, we're back into just normal times, and we have so much uncertainty in the market that it's crazy to me. So we are seeing some kinks, even in the Qs that have been, holding things up. Everything's up big today except for the Qs, and it looks to me like if that takes us down a little bit, that's going to be a little bit of trouble for the market. So, yeah, it's a crazy market. No one's bullish, which is actually bad, and but we are starting to see some signs of life in the volatility, contango. That's starting to. So I'm here, Mark. I'm going to do a very light call for a turn here. It's 300 for the SPY. I think we're going to see an interim top. I'm going to hang my hat on that, Mark.
Well, if you listen to the show for a while, listeners, Matt was kind of early. He was one of the first really calling out there back earlier this year that this seemed like we were poised for a new regime on the vol side to the upside. He thought that turn to the upside was real. It had some legs to it, and sure enough, it did. So you certainly want to give what he's calling for now a little bit of extra credence, perhaps. And I'm kind of with you, Max. I don't want to be in this position here on the network where I'm cheerleading against this market. That is not what I want to do. I hope the market is correct. I hope the worst is behind us. I hope all these vaccines come to pass. I hope that this is behind us. This is a mere blip on the radar. It's just I'm not seeing anything to really support all of that outside of what you mentioned, the massive Fed stimulus and all the other things like that, and the somewhat forced opening of our economy, maybe perhaps in spite of what the science is telling us out there. But that's all a conversation for another day. But yeah, I'm with you. I certainly, at these levels, perhaps would be a little skittish about just diving in naked into the markets, which is a good time to turn our attentions, Mr. Cott. I'd like to have him join us because he has his finger on the virtual pulse these days of what's going on in the advisor space. Mr. Cott, same question for you, but let's spin it a little bit because you're obviously out there talking to a lot of advisors. I'm curious, maybe what are you hearing anecdotally from advisors who are, of course, hearing things directly from their clients? Are they looking more for hedging activity right now? Are their clients coming to them saying, hey, I'm into this, I'm buying into this bull, I want to get long with both feet here? What are you hearing anecdotally on that front? And then what else is catching your eye out here, and what's been lighting up your tape since the last time we chatted a month ago, sir?
Absolutely, and I will echo Chris's sentiments because obviously they have a lot of dialogue with the RIA community, the Registered Investment Advisors, as well as Matt does. And I think Matt is sort of like the Deborah Bricks or the Anthony Fauci of the options market. I mean, Matt is absolutely he's the data-driven, predictive science that we're trying to figure out. But I mean, all kidding aside, look, I mean, we've seen, all of us know, some unprecedented gains here the last couple months after March. And advisors who implemented hedges, Mark, that I'm hearing from, literally that has been a very favorable outcome. Probably they were listening to Matt back in September of last year and following ORATs and such, and they were preparing for maybe some tumultuous times in 2020. And then there are other advisors that are looking for opportunities. I mean, I'm not at liberty to sort of talk about specific names or sectors or industries, but I think there are some that were out of favor that have now come back in the last couple of weeks, and I'm hearing that from the advisor community. One of the things that I think is interesting this week, I'd be remiss if I didn't give a shout out to my father, who's a veteran of the Korean War, and all the veterans that we acknowledged this past Memorial Day, but that one of the exchanges I represent, the New York Stock Exchange, did open up this week. And I believe that another exchange that Mark, you and Matt and Chris are very familiar with in Chicago, I believe, in the next couple of weeks is going to open up. So there are signs in the economy, there are signs in our daily lives, and there are signs in the derivatives industry that things are trying to come back to a new norm. And when I bring that back to the advisor community, and what I hear from them is that clients are still very anxious. We are getting into warm weather here, and I mean that might play into certain industries that have to do with what individuals and their families are thinking of doing. And I'll let Matt and Chris elaborate specifically on that a little bit more. But I believe, Mark, that we're seeing a little bit of a tide change, no pun intended being here in Florida, but that advisors are looking for sort of alpha strategies, some ways to kind of enhance some income. And I've been hearing more and more from them about, some of these put right strategies and covered calls. Put
rights and covered calls. Well, that certainly is probably accounting for some of the volume we're seeing out there right now. Again, that's another silver lining we're seeing out there, Eric. No one wants these circumstances to drive volume, but we know at the end of the day that they do usually translate into a lot of volume out there. You guys at OCC, the mothership of OIC out there, have been quite busy since the last time we chatted. Why don't you break it down what you guys have been seeing on the volume front over the past month, sir?
Yeah, and I appreciate that, Mark. Obviously, we're seeing unprecedented volume. Even in April, volume was up over almost 42, almost 43% from the prior year in 2019. So, things are running very efficiently, even with volatility going on, and the majority of the floor, as well as the exchanges, doing this remotely. So a lot of praise goes out to the OCC, the Options Clearing Corporation, as you mentioned, Mark, the world's largest equity derivative clearing organization, and the exchanges that they're involved with. It has been very efficient, even during these unprecedented times, because Matt and Chris just said it. We're in uncharted waters here, even as the exchanges start to look to bring people back. So, we're seeing these, significant volume months, and that, folks are realizing the value. I'll give a shout out to your show, Mark, because, again, with people being at home and understanding, it requires a little bit more of the diligence and the discipline to realize that option strategies can provide solutions in any market scenario. And I probably got that from Matt or Chris. I'm always, sort of getting my best statements from others on the show. But, it's interesting that, the advisor community, when there is, volatility on the horizon, Mark, it's sort of as if there's a flood in someone's house. That's when they start to think about that insurance. We've talked about that. When volatility rears its ugly head, that's when advisors start, kind of thinking again about ways to implement strategies for their clients.
These are the times when the phone starts ringing and they say, hey, what about that put thing you told me about 6 months ago? How does that work again? So, and also on the flip side, when vol gets high, people like to harvest a little bit of that. Hence the old covered calls that you were talking about, Eric, and the interest in them. In fact, a little birdie has told me, Mr. Matt, that you've been looking at a little bit of a covered call study on an index. I'm not that familiar with it, the SPA 500. I'm not sure what this is, sir. Why don't you break it all down for us?
Yeah, Mark. So we've been inundated. We've actually never been busier. So there's a lot more people looking at options, looking at callers, covered calls, and so we decided it was time to put a big test together. We have this optimizer back test so that we can run thousands and thousands of tests. So one of the things that I wanted to do was get out there with some of the bigger names in the S&P 500 and just see what it was that was the best ways to trade these covered calls. We looked at earnings. Should we trade through earnings or should we avoid earnings? We looked at the best maturities. Should we go short term, long term, medium term? Where is the sweet spot? We looked at delta and percent of the stock price. Should we go near the money, out of the money? So we tested, in all 3 million combinations, and I want to announce the winners here. So we did all this work for you. Here are the winners. I don't know if you guys want to guess, but I'll just I'll cut to the chase here. So, we tested, so let's start with maturities, 10 days all the way up to 240 days. The winner, 30 days. The deltas, from 5 to 50 every 5 delta. The winner was a little lower than I thought. It was a 10 delta. But also avoiding earnings was better than trading through earnings. So we would exit before earnings. And we tested some exit strategies too, exiting after a certain profit, exiting after a certain delta was reached. But it turned out that doing nothing was actually the best from a return and from Sharpe ratios as well. Let's see. I should also say IV percentile was important. So we tested under 33. We tested between 33 and 66 as from a percentile basis. And we also tested above 66. So percentile was a yearly percentile. So it basically puts them all in a line and breaks them up. And as you might guess, the highest percentiles were the best. So, I know that's a lot to kind of chew on there, but, so you're selling the small delta, but you're selling at a high volatility. So you are getting some, decent premium, and you're selling a 30-day. So you're getting some, you have a decent maturity, and you're avoiding earnings. So, at least for some of the bigger names that we tested, names like Microsoft, Apple, Amazon, Johnny John, Telephone, Google, Berkshire, JPM, and a few other large ones. Those were the best ways to sell these calls, and we've developed a scanner that where you could plug that right in, click on it, and all the calls come up. So like we were seeing Intel, Verizon, Amazon was in those. It was in that scan, and then it identifies the prices and where likely fills to match the back test, and you're off to the races. So Mark, that was it. That was 3.5 million free tests for the people out there.
A 10 delta. That's surprising to me. It sounds like it was a little surprising to you as well.
Yeah, but you still get, like, I'm looking at an Intel call. It was back a week ago when I did this. It's still 50 cents. Stock was at 62 at this point, and that was a 69 call. So I mean, that's a decent.
That's not nothing. Yeah, you think 10 delta, you're getting 3 cents, right? So
but that's why you're selling some high IV stocks, in that list.
I like it. So is this going to all be encapsulated in a big report that's going to be available on orats.com, sir?
It's just in the raw form right now. So I'm going to blog about it and start putting it out there for people to look at. But you guys are the first ones to hear about it.
I like it. Breaking. You can check it out for yourselves, listeners, orats.com, ORATS. Maybe you try that covered call tester for yourself out there. Sounds like it's a pretty cool I would not have guesstimated 10 delta. So there you go. You learn something new when you crunch the numbers over there. Speaking of crunching the numbers, analyzing the data, and looking at what's going on out there in the advisor space, Chris, I know you guys over there in Swan Land are always doing that. So when you're not chatting with me here on the show, you're out there. I know you can't really hold the in-person 10th box events anymore. Maybe some virtual ones going on. We'll get to that a little bit as well. You guys also have been cranking away on the content front. I've said it before here on the show. If you're in between episodes, if you want a little bit of a fill of content on the advisor side, Swan Global Investments, they have the blog. A bunch of other stuff cooking over there, including an interesting piece I came across, Mr. Chris, pretty timely, probably why you posted this, called 3 Ways to Retain Your Clients During a Crisis. And you give advisors out there effectively ways to strengthen their client relationships. Talk about communication. You're talking about managing risk, which is something we like here on the show, and also something that's probably important, particularly in the maelstrom of March, which was kind of being the voice of reason on the other end of the phone. Why don't you walk us through some of your findings here and some of the analysis you guys did over there at Swan, Mr. Director of Risk?
Yeah, this was an article that written by really one of our star writers here, Mark Odo. And, again, it's exactly what you said. It's 3 ways to retain clients during a crisis. And, we've all agreed that at the beginning of 2020, even though there may have been some warning signs, I don't think anyone on this call predicted the type of sell-off that we experienced, a couple of months ago, and even less the type of rally that we got. And so like you mentioned, there are three things that are very important to try to retain clients. Communication is number one, and that means proactive communication, not reactive communication. And that's really telling your clients, what is their risk reward profile? Where do they stand with the market movement? Where do they stand with volatility, et cetera? And you're really trying to walk them off that ledge. And that's why strategies that are always hedged helps to you don't sell at the worst times. I think what's going on also in the marketplace is there are a lot of people that I knew that sold out of their portfolios. They said, that's it. I can't take it. I'm going to cash. And that's usually at the worst possible time. And now they're turning around and wondering and seeing that they just missed 20% of 20, 30, 40% of a stock market rally. So, communication is key, making sure they understand their strategies and where they stand. And that kind of ties in with being the voice of reason, right? Have a good relationship with your clients and make sure that they don't make those wrong decisions at the wrong times, because that's what they're paying for. That's what they're paying you for, right? If you're a registered investment advisor, your clients are paying you for your expertise, your knowledge, whether it's portfolio management, hedging, risk management, whatever. That's why, that's how you make your money, to make sure that they stay in their investments over the long haul. Yes, there are risks out there. Yes, you should be hedged. And that will keep you in the marketplace for a full market cycle, so that you don't have to second guess. Oh my goodness, the Nasdaq's actually up 8% on the year. Nobody here again would have said that 30 days days ago. So, and then lastly, again, to kind of sum it all up, is effectively manage your clients' expectations and what they expect from the product, what they expect from any type of hedging instrument that you're using, and what it's going to do during different environments, right? Not all sell-offs are the same. Not all rallies are the same, as we're seeing right now. So different products are going to act differently, and clients should have an overall understanding of all that.
Well said, sir. You can check out that piece for yourself, Mr. Mark Otto, who has been on the show in the past over there, SwanGlobalInvestments.com. I believe we're tweeting out the link as we speak as well. So you follow us over there on the old Twitters. You could see it there as well. A lot of interesting stuff popping off in the space since our last show. I know, Mr. Cott, this came across your radar recently out there as well. Folks at JP Morgan, we always talk here, really only half jokingly, about what we term effectively the alts ghetto, where all these disparate funds are just lumped together under this rubric, this umbrella of alts. Doesn't matter if it's a managed futures fund, if it's something that invests in oil wells. It doesn't matter. It's all lumped under this weird umbrella of alts. Doesn't matter, they don't correlate or anything like that. So it's always been a problem for us. And unfortunately, a lot of the options-based things like hedging or income or anything like that also gets lumped into that group along with the rest. Well, it sounds like that group may be getting a little bit smaller, Eric, out there. We're seeing JP Morgan announcing they're going to shut down 4 of their alts ETFs out there, their diversified return Europe equity ETF and their long short ETFs out there. And then their managed future strategy ETF closing as well, as long as putting on the chopping block coming up looks like in a couple of weeks here, their diversified return global equity ETF, their diversified alternatives ETF, and their event-driven ETF. Some interesting ones out here. This is not exactly surprising, maybe, that we're seeing some ETFs go the way of the dodo. After all, these are kind of record times for ETFs, particularly the ones that I've often termed the Franken products out there. A lot of those, the levered long, levered short, those kind of things, a lot of those have gone the way of the dodo. Effectively an unprecedented level of closures for ETFs so far this year. We've seen about 110 ETFs pretty much shut down. That would be more than you see in a traditional calendar year, and that's already happened as of, I think, last month when those numbers are crunched out here. So seeing a lot of shutdowns, maybe not exactly surprising, but still, Eric, maybe a little bit concerning that the alts umbrella, sir, getting a little bit smaller these days. Does that concern you as well?
It's interesting, Mark. I have spoken to some of the ETF providers, the asset managers, also some of the publications that follow, and that's where this story came from, that follow the ETF marketplace. And yeah, you bring up a good point that there seem to be a significant amount of closures this year that, given what has been going on in the marketplace pre-2020, that a lot of these funds were offering kind of, new strategies and such. You also talk about how we get blanketed into this alternative, nomenclature when we've sort of always said, options kind of differ from a lot of these kind of, asset recommendations in the ETF place. where it might have to do with emerging markets, or might have to do a little bit more on the future side, not listed options. But I did want to actually just make a mention here for what Chris was talking about, and having sat in a chair in my prior life as an advisor, I really believe that SWAN, along with other firms, but SWAN really kind of hit on some key aspects about what's important in the advisor dialogue with their clients, and managing expectations, and and trying to talk to clients about what are the important things, and not be sort of short-sighted. I think a lot of registered investment advisors and FAs have to kind of talk their clients back from the ledge. And that ties in, Mark, I guess, with what's going on in the exchange-traded fund world, is that maybe these asset managers are, I don't know, possibly a little bit short-sighted to close these things, because the AUM is not there. Maybe there's not a lot of activity. They want to kind of focus on where the flows are going. But one of the things I would say for the volume from OCC in terms of ETFs, that's clearly growing. Advisors are looking at ETFs that they have on behalf of their clients, and implementing option overlays with those. So that's something that's worthwhile noting.
It is. So if you're one of those watchers out there watching that alts umbrella of funds, it is a little bit smaller these days out there. Worth considering. Hopefully we'll see some new interesting options-oriented funds leap into the void to fill that gap. We're talking a lot of pandemic, a lot of crazy stuff out here. Let's dial it back for a second, as I like to do, particularly this time of year. We're on the tail end now of another interesting, I think, to put it mildly, earnings season. A lot of big names coming out and effectively announcing a whole bunch of nothing. We don't know what the future holds. And yet we hadn't really seen the annihilation of a lot of those names that you would typically see when a name comes out and says, we have no guidance. That's usually a big warning sign. And yet not this cycle, which is kind of interesting. So, Mr. Matt, we are in yet again unprecedented times here. You are the keeper of the earnings data, sir. What is lighting up your tape out there this week? What are some of the interesting surprises and nuggets and takeaways you have from this season?
Yeah, so earnings season usually is about 6 weeks. It starts a couple weeks after each quarter end. So we're looking at the what is this, second quarter, and how did it look? What happened was the implied earnings move just shot up. So people had no idea what was going to happen. And you're right. It seemed like the companies could get away with just saying, we have no guidance. And, so how did the option, what we usually show is how did the buyers of straddles fare? Well, they fared a little worse than I thought going into it. The first weeks were, as we state often, are not that kind to option owners, and that was true this season. Third week continued that trend, but the fourth week the option holders made a little bit, and the fifth week was actually good, and that kind of held up with history. But what happened was the implied earnings. The implied earnings move was so much greater than usual. But what you were hearing on some of these calls and we've started hearing more from our clients, and we're putting out more reports, are suspensions of dividends to preserve capital. So our list of implied dividends. So what we do is we look at kind of these relationships that you can see in the options market of in every option price, there's an assumption of a dividend, 0 to a large dividend. And what we do is we put out these reports where, where we can see something, we generate these reports, and they've foretold some of the cuts that we've seen. Some companies, they know they're going to cut. They just haven't really announced it yet. Like we're seeing American Eagle Outfitters and some Abercrombie and Fitch, some of these retailers that have been hurt. But Molson Coors Beverage looks like it's going to get hit. Our implied dividend is very low, and they have a large dividend. Wells Fargo, has a large yield. and we're seeing in the options market that they don't believe that they can continue that large dividend. Winnebago, our RVs, even with the low oil prices, Winnebago, we have a potential cut. Of course, Delta is on the list. Activision Blizzard, that's a favorite of my kids' software. So we put out this list. Some of them, have to do with, potentially with some other reasons, but mostly these have foretold some issues at least companies are having, or at least perceived to be having, with the options market. So that's the earnings and dividend rundown, Mark.
One thing that caught my eye, Mr. Matz, and I'm curious if it did yours as well. I'm looking at, you have that season report, which I always find fascinating. It breaks down every week compared to what the numbers are predicting, how it compares to historical. Check it out if you haven't, listeners. TheOptionsInsider.com is the place to go for that. And week 4 here of this season came in exactly in line with predictions at 100%. That one really stuck out to me as strange. Have you ever seen that before, Matt?
Yeah, I mean, that's just something that happens, rounding and all that. But right on the number, usually week 4, that in the past has returned, a higher number, like, is averaging 114%. So 14% return to option holders. The thing about this earnings is just the way the week fell in the year that. The earlier, I don't know how to say this very well, but it spread out the earnings a little bit. You didn't have as many in the weeks 1 and 2 as you did before. So week 4 kind of was like week 3, and week 5 was like week 4, the more profitable for option owners, Mark.
Yeah, these are fascinating times. You don't usually see that sort of alignment of the data and the predictions of what we see in the market. But again, we're in crazy, unprecedented markets, listeners. Eric, I know you're out there when you're not on this show. You're out there just churning away at what the broad media is saying on the option space and how it pertains to the advisor segment in particular. One I know that came across your radar, came across mine as well. We haven't had a chance to really discuss it on the show. Dates back to pretty much in the teeth of all this madness in the middle of March when CNBC posted a piece and had an interview on their site, I believe if it was with a researcher from Option Metrics who came out and said effectively his advice to the retail investor would be to sit tight and stay away from the options market. Now, in his defense, of course, these were epic times. We saw the VIX topping out at 80. I think he was probably referring to just coming out and just straight up buying puts at those levels without doing anything else against it to try to offset the cost. That is a challenging environment in which to put on the hedge. The horse has already left the barn, if you will, in that scenario. So there might be something to that. And then also, right around the same time, I know one of your buddies there at Mr. COTT, Larry McMillan over there, putting out a similar piece, but on a entirely different note. Larry obviously has written many seminal options tomes over the years and has done a lot of options education out there, saying he thinks a lot of investors should keep a core bearish position in the stock market and use that to protect your gains, a.k.a. having the old put on in place. So kind of a tale of two different viewpoints on the market around the same time. I know, Mr. COTT, these came across your radar, as well as I think the director of risk as well. We'll start in Mr. COTT's land, sir. What are your thoughts on these two maybe contrasting viewpoints?
Yeah, and I know Chris will elaborate a little bit on this as well. And it was interesting because, we do have colleagues of ours that are doing their media appearances remotely, as everybody else is these days, and hopefully that'll change. But I know, you're referencing back to March and in defense of the gentleman that was on CNBC and making some of those, comments that retail investors and advisors should, be sitting on the sidelines and stuff. I think, Mark, it goes back to the reason why your show, and I'm not saying this because I'm on here, but I think it's the value of the OIRN network and why the advisor's option and having, such bright minds on here is, to give clarity to the advisor because they need to see the full picture. Half empty, half full glass. You've got to understand, when you're in a situation like this, yes, I mean, you at times – Chris talked about it, Matt talked about it. Investors will maybe make some irrational decisions, getting rid of their holdings and not listen to that advisor that in essence is really the financial physician of their portfolio, is the one who's really guiding them and helping them make the right choices. And so, look, at that time, we really weren't aware. Things are kind of, maybe we're seeing a little bit of clarity through the dust here. And I know Larry, as you referred to, talked about advisors and individuals, kind of keeping a pulse on the marketplace and realizing that hedges do fit in with an asset allocation model. You just have to sort of be aware. We go back to this analogy of, what does it cost for premium for insurance, whether you're protecting that car, your home, or your life, or anything else. I mean, we're all paying these premiums every month right now, although some of us are seeing reductions. And again, there are premiums out there on protecting your portfolio that have maybe come down right now with the markets going up. So that's where advisors should be thinking about this. And, I'll sort of ask Matt at the end of this call. I'm curious about his predictions on when the NHL, when the MLB, and when the NBA are coming back. I think his covered call studies are excellent. I'm more curious about Matt's analysis from ORATs and predictions on when we're going to see live sports. But I'll turn it back to you, Mark, because I want to get Chris's analysis on that piece from Larry McMillan.
I think that would be a pretty widely read piece, Mr. Matt, if you were going to crunch some numbers, if you have any metrics at hand to analyze about opening. I think the NHL has announced some days, I think just this morning, actually. So maybe a little bit of clarity on that front. There you go, Mr. Matt from ORATs. I think that would be a very widely read blog piece if that was indeed something you would crunch. Mr. Chris, I know you pay attention to these as well. I'm sure the CNBC comments came across your radar. I know Larry's comments did, because that's right in your wheelhouse of keeping that protective position while you maintain your gains. So what are your thoughts on these two perhaps contrasting viewpoints, Mr. Director of Risk?
Yeah, bottom line, it comes to education. With the VIX at an 80 to make a statement that, well, you should be out of options is probably, there were definitely a lot of things that you could have done with the VIX at an 80. And hedging at that point, maybe, yes, it was expensive for outrights. I'm not going to disagree on that. But there were definitely other types of strategies, such as put ratio spreads, where maybe you could have hedged out a zone. You could have taken advantage of a high volatility environment. So that, again, comes down to education and what you know and what you can do during market environments. I think the biggest problem that a lot of people or retail traders lack are plans. This kind of event, even though it's something that none of us have really seen, the closest was the GFC, and that was 12 years ago, right? 11, 12 years ago. So people who have just started trading over the last 10 years and went ahead and sold that 10 delta call every 30 days, yeah, it's a pretty damn good strategy under that type of market environment. And what you had is a lot of people that got caught, because they have not seen this type of environment. And yeah, we can't predict these type of things. No one predicted what was going to happen with this event. And so being always hedged is always part of the program, right? Being part of the program, not walking off that ledge, and being able to protect and preserve capital during full market cycles. So, again, I pulled out some trades that I hadn't done in several years because we saw VIX levels I was like, wow, this is a dream come true. You only get these opportunities once in a while. So I do disagree with, well, you should completely stay out of the options market because the VIX is at a certain level. We've talked about it many times on the show is that, we carry around toolboxes and they're full of tools and we don't use them all, but we know how to use them under certain market environments and certain scenarios. If the last 10 years was a bear market, Matt would be telling us to sell the 90 delta covered call. So, you have to assess, but he'd be right on it and telling you exactly because he can assess the market environment. And that's really the trick. The trick is, number one, figure out what type of market environment you're in, and then look inside that toolbox and come out with the right tool for what you're trying to achieve.
And now it's time for us to look inside our mailbox and see what you guys have on the brain. It is time to open up the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. You guys know how to get a hold of us. A lot of you have done so. Keep those questions coming. I like to make sure we squeeze as many of you as we can onto the show every episode here. Let's kick it off really quickly. We asked you guys last week out there in the audience what you're feeling. Again, we'd like to get your pulse on these, and a lot of you have been fading this rally for quite some time, pretty much since it started. We asked you last week, VIX, it just broke through 30 to the downside. It is still there right now, about 2 points shy of that right now. You think this marks the end of the recent resurgence of volatility, or is this just setting the stage for the next move higher? Quite simply, where will VIX be 1 month from now? This is from the 18th of May, so a little over a week ago now. So where will it be effectively 3 weeks from now? And we gave you 4 choices: higher, so north of 35, lower, south of 25, around this level, 25 to 35, or you don't care, you're still in cash. And higher, north of 35, winning with about almost 46%. Number 2 is right around that level, so 25 to 35, which is where it still is right now, with about 26 point, almost 27%. Then we got about 19% saying it's going to be lower, so feeling the rally, and only about 8.5% saying they're in cash. But still a higher number than it was at the beginning of all this madness. We got Jake chiming in here from last show. Jake saying, I don't agree with that put study from your most recent episode. The author's comments that monthly puts are not effective at protecting against protracted drawdowns are absurd. Of course they aren't. That's not the point. The point is for protection during the lifetime of that option. I think if you ask the authors if they'd rather have the put or not have the put during that situation, they choose the former. He is, of course, referencing that the put efficacy study we discussed on the last episode. If you didn't catch it, listeners, go back and check it out. It's kind of interesting, very controversial, as Jake and others have pointed out here as well. I'm curious, maybe Eric, you have some thoughts on this because you're the one who suggested that study for us. What do you think about what Jake has to say about maybe disagreeing with it? And maybe if you have any additional thoughts on that study a month later, sir, you can share them with us.
Well, I want to go back, Mark. It's interesting with your analysis in terms of folks looking at higher vol on the VIX here. And my curiosity is the people that are still in cash, does that reference what Matt said? Are those the Congress people that got out of their positions that are sitting in cash right now waiting?
No, they got back in at exactly the right time, sir. I'm not sure if you missed that briefing as well. The time to buy briefing.
But I think Jake's got something to this. I mean, again, it's everybody's got their own interpretation of where things on. But back to Chris's point that relative to having hedged overlays and having protection on a portfolio, the key aspect is and again, to Jake, but it's where from my perspective, when I talk to advisors, it's what is the ultimate goal for them and their client, and at times is it cost prohibitive, or are they actually adding other legs into that where they defer some costs on it. So I'll maybe have the other guys weigh in it as well.
Mr. Director of Risk, I want to get your thoughts, but you've been invoked in another question here, so I'll give you a chance to chime in on both of these. This other question comes from Nielsen. He or she wants to know, has the risk director, so they got your title backwards, it's Director of Risk, Nielsen, has the risk director ever tried to implement the defined risk strategy on other indices aside from the SPX? How does it perform on more volatile indices like NASDAQ and the Russell 2000? Seems like there would be lots of demand in those products. So, Mr. Chris, a twofer, sir. First, if you have any comments on what Eric was talking about with Jake and his thoughts on that put efficacy study, have at it. And then what do you have to say here for Nielsen, who wants to know about how the defined risk performs on more volatile indices like NASDAQ and the RUT, sir?
Yeah, the study, when we talked about it a month ago, if you'd looked at the CBOE's put protection index, actually on a 5 and a 10-year basis, it was outperforming the SPX. Okay. Now, because of the rally we've had over the last month, it's only outperforming on a 5-year basis, but it's right behind it on 10-year. If you look at a longer time frame on a 20-year basis, yes, it is underperforming. So I can see how someone could say, well, over a very, very, very long period of time, hedging your portfolio doesn't make sense. But the problem is during that period of time, we have these full market cycles embedded. We also have these tail risk type events embedded. And when you assess a portfolio and the return of a portfolio, it's not just about how much money am I making here. The other components that you have to assess is, well, what is the volatility of those returns? And also the one component that hardly ever gets talked about is the utility. The utility to know that you're hedged, the utility to stop you from going to cash and then missing out on a 40% rally, like just what has occurred in the marketplaces at this point. So those are some of the intangibles that a study like that do not quite capture. So Now, which hedge should you have is debatable. Again, it goes back to what kind of marketplace or what kind of overall outcome you're trying to seek. And I don't know if you guys have been following on Twitter. There is a good debate. It kind of ties in with this piece versus a famous tail risk strategy that's out there. And they're going back and forth, debating, tail risk is needed. And the other one is ping-ponging back, well, you shouldn't hedge at all because over a long period of time, it's just a drag on your portfolio. So if you guys haven't caught that one, it's pretty interesting. As far as products are concerned, yeah, we DRS it on multiple products. We actually do have mutual funds on foreign developed, emerging markets, and small cap. And we also have some in-house R&D type accounts on gold, real estate, bonds as well. So, I mean, the products do act slightly differently. The underlying component is that you are always hedged and always invested. You can see like TLT and the moves that TLT made during the crisis a month or 2 months ago. So it was pretty unprecedented. But yeah, the DRS can be applied to multiple underlyings. They do trade slightly different, but again, the overall component is always invested, always hedged, reduce volatility, and add utility.
I do think the utility portion, as I mentioned last show, is definitely underrepresented. That comes in many forms, and be able to sleep at night, things like that are not really quantifiable but demonstrable when it comes to clients and their ease, which is what your job really is at the end of the day. Put your clients at ease. Not only make them money, but put them at ease a bit as well in these tumultuous times out here. I got a timely question from Milton here, then I think we'll wrap up. We're going a little long. So much to talk about. And you guys have so many question listeners. I want to make sure we squeeze as many of you on as possible here. Milton wants to know, will we see more flow now that the floors are coming back? Eric, you just alluded at the top of the show, the NYSE is actually back in a limited capacity over there. More salient for us here in the option space is that SIBO announcing, I believe yesterday, they're planning to come back on June 8th and reopen their trading floor, so things like the SPX and VIX and others will finally have their floor presence again, open outcry. It'll be limited, and there will be all sorts of social distancing in place, but there will exist. Matt, this has been a question people have been asking us for a while. We've been kind of chomping on this one for a little bit out there. What exactly the impact of open outcry is? We've seen a lot of flow going up during these all-electronic markets for the last couple of months, but also we've seen a lot of issues. We've seen spreads, as you've documented well over there at ORAT, spreads widening out, issues with liquidity, volatility spiking. Some people have speculated on this network that perhaps the WTI going negative wouldn't have happened if there were folks actually standing in the crowd to perhaps be a backstop against that. So there's a lot to parse as the floors are coming back. Milton wants to know, Matt, think you're going to see more flow now that the trading floors are back. What are your thoughts, sir?
Well, yeah, I'm a believer in having people stand on floors and stand up for markets. They don't need to stand on the floor, I guess, but stand up for markets better. We need more market makers. The exchanges have not done the best job, in my opinion, over the last many years, really appreciating and making market makers able to handle the capital requirements and all the technology requirements. So I think that did cause some major trouble during this COVID crash. So hopefully they look at that. Well, to the question, our friend Henry Schwartz has done some good work on this about what the floors are good at, and they're good at a lot of these more difficult to price up relationships. So, some what you see is when the floor is open, you're able to get some different types of trades go up, and which I found very interesting. That you'll see some more complex trades. You'll see trades with often stock or delta neutral. So, definitely the floor has its place right now in, just the ability to go down. I was an ex-market maker. Mark, you were too, Chris. You remember, those big orders that came down, and you had to talk and negotiate, and where are you going to do the stock and all that. And I think it's it's still what's happening down there. They're getting some big size done on these different types of options. So opening the floor will allow those large trades to go up. Mark.
Unfortunately, that music means we've come to the end of another epic journey to the world of the advisor's options. Leave it on a little bit of love here. This comes from, what is it, S-Book. S-Book says, great program, nothing else like it out there. Well, that's the goal there, Mr. or Mrs. S-Book, and everyone else who's been writing in. Glad you're enjoying the program. Glad it's helping you through these troubled and indeed turbulent times. That's what we're here for. So glad you're getting a lot of value. All of you out there who've been writing in with similar sentiments, we thank you. You guys are the reasons, quite literally, that we keep doing this show month after month. And, you know, if you're interested, if you want more data, more nuggets, more analysis, more things to sink your teeth into in between episodes of this program, let's find out what those are right now. Let's go around the horn. Let's start in the land of Mr. COTT. Sir, if folks are intrigued, maybe they want to check out what's cooking in the land of OIC. Maybe you got some interesting little nuggets up your sleeve you want to tease with us, sir. Now is the time. The floor is yours.
Well, thank you, Mark, and always great to be with the other two guys. Really appreciate it, Matt and Chris. Would just let everybody know that we have some potential upcoming collaborations, digital collaborations with some of our exchange partners. So I would encourage all your listeners, as they always do, to go to www.optionseducation.org or to leverage, no pun intended, the great folks at Investor Education. That's our investor services line, 888 Options. So just encourage all of your listeners, as they do, to follow this show, but also to utilize the Options Education resources that we have at their disposal.
There you go. And the place to begin that journey, optionseducation.org. Click on the Financial Advisors tab over there, listening to this show. You'll find a lot of nuggets and data and interesting analysis there to keep you calm, keep you happy, keep you informed in between episodes of this fine program. Mr. Director of Risk, same question for you. We touched on the blog you have cooking over there. What else do you guys have up your sleeve over there in the land of SWAN, sir?
Well, we continue to produce great content. Another piece out there by Mark Otto is, does fixed income need fixing? The DRS is a capital preservation solution. So it talks about how investors can use the DRS as an alternative to fixed income. So check out the website, swanglobalinvestments.com.
There you go. SwanGlobalInvestments.com is the place to go. And last but not least, Mr. Matt, we just talked about the earnings reports, talked about this new addition, this new wrinkle to the offering, the covered call analyzer. You've got the dividend impact, a lot of stuff cooking. If folks want to kick the tires for themselves, where should they go? What should they do, sir?
Yeah, I just had a guy offer some or want some consulting work. So we worked on how to protect a gold position. So that was a lot of fun too. So we do all sorts of things over here at ORATS. You know, look me up, Matt at ORATS, M-A-T-T at O-R-A-T-S, and of course ORATS.com. And you know, we put up a lot of content on the Option Insider blog too, Mark.
You do. Earnings season is the hot time for you guys. You can check out all those earnings move results, and earnings season reports over there at theoptionsinsider.com. And hit Matt up, Matt at ORATS, ORATS.com. Maybe you have a query he hasn't seen before. Maybe you want to hedge your palladium position. Who knows? Hit him up, Matt at ORATS.com, or just go to ORATS, ORATS.com. Check out that screener, the back tester, which you haven't even really had a chance to. I'll talk about on the show here today, a bunch of other cool stuff. ORATS.com is the place to go. So, ORATS.com, and then optionseducation.org, and then, of course, Swan Global Investments. All those three places will keep you informed in between episodes of this program. And on behalf of Mr. Matt and the Director of Risk and Mr. COTT and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such questions, for listening live. We love you guys, too, and we'll see you back here next time for more of The Advisor's Option.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.